Hey, what's up everyone, and welcome to the School of Personal Finance. In this video, we're going to talk about debt and credit and loans and how the interest rate works on all of these different types of loans that are out there. So now this is the fourth video in the Personal Finance for Students video series. But now I keep saying it, even if you're an adult, I'm sure that you will find this information helpful as well. All right, let's get to it. All right, so let's start with debt. So all debt is the amount of money that you borrowed and are obligated to pay back. So people use debt for all different reasons. Usually it's to make a big purchase where they don't have the actual amount of money that they need, so they borrow money in order to make that purchase and then pay that debt or that loan back over an agreed upon period of time. So a couple of very simple examples might be like a student loan, where if the cost of college is more than what you currently have right now, you could take a loan and then pay that loan back over a period of, let's say, 10 years. Another example could be a car loan. If you want to buy a car that costs $30,000, you can take out a loan to finance the car, and then you will have a monthly payment that you are required to pay that loan back. So you get the $30,000 up front to purchase the car, you walk away with the car, but now you are in debt. You owe $30,000 to whatever bank or financial institution gave you that loan, and you are required to pay them back over that agreed upon amount of time. Another example is a mortgage. When you go to purchase a home, you don't have hundreds of thousands of dollars sitting around to go ahead and buy the home. Instead, you take on debt. You take out a mortgage from the bank to purchase the home, and then you go ahead and you pay the bank back over an agreed upon period of time, typically 30 years, a 30-year mortgage. Now, when you borrow money, you are not only going to have to pay back the amount that you borrowed, but you are also going to have to pay interest charges on top of that. And the amount of interest, it depends on many different things. But the financial institution that is lending you the money, or even the individual that is letting you borrow their money, they're going to have a required interest rate that they're going to charge you in order to compensate them for giving you access to their money. Because once a bank or an institution or an individual lends you the money, they no longer have access to it to go ahead and invest and try to grow that money or use it for whatever other purposes they might have. So they're going to charge you interest. Now, the interest rate, it is determined by market factors, so whatever the interest rates are in the current economic environments. But on top of that, it is also determined by your credit risk or your credit worthiness. So if you are very young, just starting out, and you have no credit history, you might have to pay a higher interest rate than somebody who has been borrowing money for decades and is very well established and has a high paying job and has a long history of paying their debt on time. Another big factor when it comes to interest rate is going to be the collateral. So when you take a mortgage out, the home is collateral. So if you don't pay back that mortgage, the bank could come and take your home. It's called a foreclosure, right? If you take a car loan and you cannot repay the loan, then they will come and they will repossess your car. They will take the car away from you. Then you have uncollateralized loans. So like credit cards, when you go around and you swipe your credit card and you run up a credit card bill, there is no collateral for that. The credit card company, they can't come and take your house if you don't pay back your credit card bill. So because of that, the risk is higher. So the interest rate that they are going to charge you is going to be higher. If you walk into a bank and you apply for a personal loan, there is no collateral with a personal loan. So if you default on that, then they do not have much recourse to go after you. So those interest rates, they are going to be much higher than a car loan, for example, or a mortgage, where there is collateral for them to come and take in the event that you just stop paying on the loan. Now, when it comes to the interest rate that you're going to pay, there's really two different types. There are fixed rates and then there are variable rates. So with a fixed rate, it's exactly what it sounds. The interest rate that you are paying is fixed. It will stay the same throughout the entire term of the loan. Simple example, let's say you get a car loan, the rate is 5%, it's a 5-year loan, so you have to pay back that money over 5 years, and it's going to be 5% per year is the interest rate, and that could not change. For the variable rate loan, you guessed it, the interest rate, it is variable. it can change. So a good example of this is with credit cards. So credit card companies, they could change your interest rate basically whenever they want to. So depending on the interest rate environment, depending on if you make your payments on time, if you go over your credit limit, they might jack up the interest rate that they're charging you. So when it's variable, you have to be on top of it. You have to make sure that you understand what the current interest rate is that you are paying. Now, it's also important to understand the difference between like an interest-only loan compared to an amortized loan. So for example, with credit cards, most of the time they will only make you pay the interest charge plus maybe a little bit more every month, or a home equity line of credit. For those, they are typically interest-only payments until you reach a certain point, and then they start requiring you to pay back some of the actual principal of the loan that you owe them. Now, with an amortized loan, these are typical with like a car loan or a mortgage, a 30-year mortgage. Let's look at a simple example with a car loan. Let's say that you borrow $30,000 to purchase a new car. You take out a 5-year loan, and the interest rate is 5%. The bank is going to do a calculation. They are going to run the numbers to see how much do you have to pay every single month so that they get their 5% interest per year. And by the time the 5 years are up, you owe zero. So there has to be that right amount of principal, the amount of the $30,000, plus the interest included in every single payment, so that at the end of it, you have paid the balance down to zero. So in that example, the payment would be $556 every single month that you would have to pay in order to pay off the loan in 5 years. And in that first month that you owe $30,000 to them at a 5% interest rate, the amount of interest in that first month would be $125. So that means $125 would go to the bank towards interest, and then $441 would be left to go towards paying down your $30,000 loan that you owe them. And it's the same thing with a 30-year fixed rate mortgage. So let's say that you buy a house, and you buy a house for $400,000, and you're able to put $100,000 of your own money down on the house. So you need to borrow $300,000 in order to buy the house. That's going to be your mortgage. And you do a 30-year mortgage, and you're able to get a fixed interest rate of 4%. So in that case, your monthly payment every month for the next 30 years would be $1,432. That is the amortized payment that you would have to make of principal and interest in order to be done with the loan after making 30 years worth of payments. And just to show you how big of a difference the interest rate makes, on that same mortgage, if you had a 6% interest rate, then the payment would go up to $1,799 per month. So that is a difference of $366 a month for the next 30 years, just because the interest rate went up to 6% as opposed to being able to get it at 4%. All right, so let's wrap this one up by talking about how the interest works on credit cards, because it's a little bit confusing and a lot of people just don't understand it. And credit cards could be so dangerous. They could really bury you in debt if they are not used the correct way. So with credit cards, you're able to go ahead and make purchases, swipe your card and buy things, and you're not going to pay any interest on that money yet. So you go ahead, you make purchases, you get your credit card statement, and they tell you, listen, you made all these purchases, it's all itemized for you, you owe $800. So now as long as you pay that full statement balance by the due date on the credit card, then you will not owe any interest for all of those purchases. So in a way, it is like a free short-term loan. They're letting you borrow their money. As long as you pay it all back by the due date on the statement, then you pay them zero interest. This is the correct way to use a credit card. You never want to pay the credit card companies any interest whatsoever. So as long as you do this, then you will not owe them any interest. Where it gets tricky and where you get screwed is if you do not pay the full balance by the statement due date. Even if you only leave a very small balance, it will still screw you. So what happens is, let's say that you did charge that $800 and you paid $700 by the due date. So you carried $100 over to the next statement. What this does is that you will now start paying interest on that $100, which isn't the end of the world, right? Even though the rates are probably obscene, like 20% or something. So you'll start paying 20% on that $100 that you owe, But now any purchases that you make going forward, the credit card company will start charging you interest on the day that you make the purchase. So if you go out to lunch and you spend $50 going out to lunch, you are going to start paying interest on that lunch the day that you buy it. All right, so you do not get that grace period anymore, that time where you're not getting charged any interest. So as soon as you carry a balance from 1 month to the next, things start to snowball against you. It starts to get ugly. You start paying interest on these balances, and it could really start to add up. So if you find yourself in this situation, the right thing to do is to just stop using the credit card altogether and make sure that you have 2 consecutive months of not owing anything on the credit card. Pay the statement balance in full. Do not use the card. Let another statement cycle go by just to make sure that you are going to get your grace period back, and then you can start using the card again. But it's very easy to go in the wrong direction on this, to carry a balance, not have all the money to pay it off. You carry it, you still use the credit card. Now you're paying interest as soon as you make those purchases, and they're starting to add up, and now you're paying interest on the entire balance. You carry it to the next month, and it just starts to go against you. And this is how people find themselves in credit card debt. So you don't want to even let that start. You have to nip it in the bud before you get to that point. So here's the hard rule of thumb. As soon as you carry a balance over from one statement to the next, put the card away and don't use it anymore. All right? Do not pay interest to credit card companies. It is a waste. Make sure that you are paying that full statement balance off by the due date. So unfortunately, debt is a part of life. It's something that all of us eventually need in order to go ahead and buy the things that we want to buy, like a home or a car. It's hard to pay for those things out of savings. Most people don't have the amount of money saved that they need to make these very big purchases, so they go into debt. But you have to understand how it all works, and you want to be very smart about it. And not all debt is terrible. Like, for example, if you could use debt, if you could borrow money from a bank to go ahead and buy an asset that goes up in value, then this is called leverage. Then you could actually use other people's money to make yourself money. That's a topic for another day, but I just wanted to plant the seed on that. And a perfect example of this is people use debt to buy real estate. So to buy an investment property, you take out a mortgage from the bank, use the bank's money, you put down a little bit of your own, and you go ahead and you buy a rental property where you could get an income from it. You could start making money from it. So that's an example of good debt. But most debt out there is bad. Most people use debt to buy things that go down in value, or they don't even know what they bought, using it on credit cards or car loans where the cars are going down in value. They're depreciating in value every year, and you're carrying the debt, and you're, a slave to these payments you have to make every single month, and it eats up all of your income. You don't want to have debt. Debt keeps you broke. All right. So you want to have money in the bank. You don't want to owe anybody anything. I mean, mortgages, they become a part of life. But personally, I do have a lot of debt in the world because I do have rental properties. I do own real estate where I use the bank's money to buy these homes. I get mortgages on these homes, but the people living in these homes, they basically pay the debt down for me. They pay the mortgage for me. So again, not all debt is bad, but you just want to really understand it, and you want to use it wisely. Many people, they get buried using debt, and it just adds stress and pressure to your lives. So you want to make sure that you understand how it works. All right. I hope that you found this one helpful. I'll see you in the next video.